Dear viewers, welcome to this episode of Expert Speaks. In this video, I'm going to ask the expert of the week, Mr. Vetri Subramaniam, Chief Investment Officer at UTI Mutual Fund, about how things have changed in India and what is giving that confidence to the investors to pour more and more money into India. This is NRI Money Clinic for you, and I'm Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, before I get started with the video, a sincere request with you all. You all watch my channels day in and day out. Do subscribe for the channel. If you have not yet subscribed for the channel, please hit that subscribe button now and press the bell icon. I release 2 videos every week, 4 p.m. IST on Tuesday and 4 p.m. IST on Friday. Do not miss any of these value-filled videos. Your subscription matters for us. Click the subscribe button now. Dear viewers, expert of the week today is Mr. Vetri Subramaniam. Mr. Vetri Subramaniam holds a postgraduate diploma in management from Indian Institute of Management, Bangalore. He joined UTI in the year 2017 and he is a group president and head of equity. Before he joined UTI, he has rich experience of working with companies like Invesco Asset Management, Motilal Oswal Securities, Kotak Mahindra Asset Management Company, SSKI Investors Private Limited, and Kotak Mahindra Finance Limited. Let us see what message he has for the audience of NRI Money Clinic. Mr. Vetri Subramaniam, it's a great honor to carry you on my channel. Welcome to this episode of Expert Speaks. My audience has lots of questions for you. When a person of your stature comes on our channel, we will be asking you a lot of questions what many a times we don't get an answer on. Today's video, I have designed it in 3 phases. One about the past, one what is currently what people can really make use of, and one about how the future is likely to unfold. Of course, future is uncertain, nobody can predict, but we can try to guess what is there in store in months and years ahead. That's how we have designed. First part, let's look at what happened in the 10 years. We see a lot of domestic flows are coming into the market. We heard that Indian market is all about FIIs inflows. When FIIs bring money, it will dance to the roof. And when they pull out the money, it will fall like 9 pins. This has been the saying about the Indian market. But there is a huge amount of domestic flows which are coming into the market. And every time an FIIs goes out, the domestic crowd rejoices. What exactly has changed in the last 10 years?
I think that's a very good point you make, Mr. Bhatt, because, the mutual fund industry has grown more than 6 times in a period less than 10 years. So there's been a phenomenal growth which has happened. If you look at the total ownership of Indian equities by domestic mutual funds along with insurance companies, and, now, of course, we have certain other provident fund and pension fund organizations which are also investing in equities. When you take all of them together along with the Indian public, the ownership goes up to over 20%. In fact, this is the first time in my career where domestic number is rising and overtaking the total foreign ownership. In 1993, when the market was open to foreigners, foreigners owned 0% of Indian equities. And over a period of almost 25 years, from 0, they went to almost 24-25% of the market. But in the last few years, Indian exposure to the markets has gone up. I think this is a function of 2 things. One, we have very well-regulated markets. That we have high-quality businesses which are available, which investors can purchase. And there is more widespread acceptance of mutual funds as a route through which people can take and make investments in the marketplace. And also, this has become, I think, increasingly the main conduit through which people are actually planning and trying to achieve their financial goals over the medium to long term. So I think it is a confluence of events which has caused the domestic ownership of markets, just retail and institutions, to exceed that of foreigners. I will, however, add one caveat to the statement that market shakes based on foreigners going in or foreigners coming out. Markets will always shake. That is the nature of equity markets. It does not matter who's buying and who's selling. Markets will always shake. And what we should always remember is high valuations tends to create shakeouts cheap valuations tend to create shake-ins, if I can use that term. So to presume that just because foreigners are not as dominant as before, markets will not shake is a mistake. It is the nature of the beast of equity markets that it is volatile. So keep that in mind when you plan your investment journey. This is not about domestic versus foreign. It's about using equities to achieve your financial goals.
Mr. Subramaniam, in any orderly growth of any industry, the role of regulators becomes very important. Unless stringent regulations, the regulations which make things simpler, which make things easier, which gives confidence to the investor community, the monies cannot come in. Can you take us through what changes the regulators have brought in for making this happen for the investors in the last 10 years?
Maybe I will just stretch that and go back to 30 years because I started my career in investing in 1994. This was an era where you used to have physical share certificates. So when you bought a particular company, you would receive a physical share certificate. And then there was a very complex process through which you would have to send that to the company to get it transferred into your name. Even for mutual funds, there used to actually be share certificates at that point of time. I think one of the most remarkable evolutions which has happened in our ecosystem, not just mutual funds over the last 30 years, has been the continuous use of technology, even before the term digitization became popular, to move from the era of physical to the era of virtual. So we moved from trading on the floor of the Bombay Stock Exchange to trading electronically on the NSE and the BSE. We moved away from the world of physical shares to the world of DMAT. We moved to an environment in which you could move money to your broker and receive your shares, at one point of time in T+3, that became T+2. Now it's T+1. And in fact, these days, if you do any transaction, by end of day, you will receive confirmation from the exchange, from your broker, from your mutual fund saying that we have taken cognizance of this transaction. This would not have been possible without the active involvement of regulators to provide direction, to use technology as technology became available, and make sure that all of this is used to provide convenience, security, and safety to investors. So I think it's been a very long journey. I will also add one more element to this. The availability of information. When I started my career in 1994 in investing, we had to go looking for information about companies, looking for information about mutual funds. Nothing was available easily. There were no rules regarding how companies would share information with you. There were no rules regarding how mutual funds would share their portfolio with you. So all these rules which have come over time have put the onus on companies, on asset managers, and everybody who's part of the financial system that you must make disclosures to your investors. These could be financial statements, these could be portfolio holdings, these could be, for example, some of you would be aware, just 2 months ago, SEBI implemented a stress test for small and mid-cap schemes. The whole principle was one of disclosure. Do the test, take out the information, put it in the public domain so the investor is aware and they are empowered. So I think this has been the journey which has enabled the industry to, as I said earlier, go up 6 times or almost 7 times now in terms of size over the last decade.
I am very sure these steps have given so much of a confidence for the general public to come big time into the market. And over the years, this confidence has only grown. Apart from the regulators, I personally feel the ease of doing business also becomes very, very important. You say that you write a form and you mail it and you send it by courier. It all consumes time. See, one of the things which made things simple has been the technology part. It's just not the technology at one place, it's the technology at the trading level, at the mutual fund level, at the your CAMS, CARVI level, and at the investors level. How does the technology has evolved over a period of time? And what is the likely thing which might happen going forward, and how further it might accentuate, making it a nice place for investors to park their money?
So I think, there are 2 elements in terms of enhancing comfort and providing convenience to investors. One is to make sure that, money is not stuck somewhere in between. So if somebody wants to deploy money, they should be able to deploy the money such that the investment starts to earn a return as soon as possible, right? So that I would say is point number one. I think we have already come a very long way because we are already in, T+1 environment. And now we are talking about T+0. So some of this in terms of making sure that cash is never lying idle and it is always being put to use as some of the things that we have managed. Now, of course, if you redeem a mutual fund or you sell a share, you will receive the money only on T+1. But as I said, moving towards T+0 allows you to actually realize the money on the same day as well, which means it also allows you to a greater level of flexibility if ever an emergency were to arise whereby you need your money instantaneously. The second thing where I think, the system has significantly improved is in terms of safeguards, right? Because there is a lag between the time the investor deploys the money and he receives the units into his, statement, so to speak. Now, all of this has happened in the background, Mr. Butt, but the regulator has taken great lengths to make sure that at every point of time, the investor's interest is protected so that the money transfer that happens into the mutual fund, the money transfer that happens when the mutual fund buys securities on the stock exchange, how that money flows into the clearing corporation of the stock exchange, the shares come back into the account of the mutual fund, and therefore, all the way through, there is a proper chain which is happening at the speed of light to ensure that never is an asset stuck between where it originates and where it ends. And at that point of time, there is a risk of fraud. There is a risk that assets can be, siphoned away. So all of these things the regulators have done have actually ensured seamless flow of data and transactions. And I think this greatly enhances, investor safety. I'll just add one more point. The other thing which has happened, which is not necessarily regulator driven, but simply because technology is available, each of these things can now be accessed through an app, through the internet, through chatbots. You can get information back. Having information at your fingertip is a wonderful thing, but people have to learn to use it well, because sometimes information and transaction access being available at the fingertip makes people do more things than they should be doing. I would say stick to your financial plan, but having all of this information available is a wonderful thing from the investor's point of view.
Thank you, Mr. Vetri, for those answers. Let's move from the past to the present. At any point of time, people have a need of fixed income. People are looking for defined benefits. People who want a stable source of income. People want predictability. And many times this gets complicated because of the factors of interest rates movement within the country, interest rates movement outside the country. See, it has been predicted that India will go through a falling interest rate regime, and the interest rates must have come down. That's the popular discourse which is happening in the marketplace, but it has been kept higher up because of interest rates which is outside of India, in the developed world, particularly in the US. As a fund house and as a fund manager, what is your view on current fixed income and how investors can make best use of the prevailing conditions now?
I think one of the remarkable developments, and it's happened during this recent decade, has been the focus of the Monetary Policy Committee on targeting inflation. And because this is a joint agreement between the RBI, the MPC, and the government, what we have seen in the last 7 years has been a coordination of policy between these two entities to try and control prices. Now, when inflation is well controlled, fixed income actually becomes a good investment that people can consider in their portfolio for two reasons. One, if it is paying you a rate of interest which is more than inflation, it is creating some value for you. The second reason to consider fixed income in your portfolio is simply the fact that it is a less volatile instrument. B, it can give better balance to your portfolio. What we have seen and what portfolio theory tells us is that when you add some fixed income into your portfolio, it does not reduce your aggregate return, but it certainly reduces volatility. So what we in the industry call risk-adjusted returns actually improve when you bring some fixed income into the portfolio. It also gives you the ability to sleep at night because, as I said, sometimes equity markets will shake. And when they shake, having that comfort of knowing that some of your money is secure for when you need it, when you have an emergency in fixed income is desirable. Now, I think there are two wonderful things that the mutual fund industry based on product structure has been able to do, which is that we have created a range of hybrid products, and these hybrid products have different allocation strategies to equity, right? So what are we able to achieve through this? We are able to create customized products which could have as low as 20% exposure to equity, or they could be dynamically managed, which means if valuations are rich, they could be at 30% equity. If valuations are cheap, they could be at 90% equity. And the remaining money gets deployed into what we call as arbitrage and fixed income. Now, the advantage of this is that you are getting a product which is giving you fixed income, but by putting it into that hybrid structure, we are also putting it in a structure where from a tax point of view, it actually becomes more advantageous to many of our investors. And finally, the point I would make is that people sometimes think of fixed income as something which will pay them a yield. These hybrid funds, and actually all mutual funds can do this, you can use the simple thought process of a systematic withdrawal plan, which we call an SWP, which is very much like the SIP. When you're young and you have money to invest, you use an SIP to invest. When you want to start taking money out because you've already been investing for 20 years, 30 years, 40 years, you can use an SWP to take money out. Again, it is very tax efficient as compared to taking a yield or earning interest from the bank because the taxation regime is different. So I would say hybrid funds allow you to get exposure to fixed income. They give you the cushion, they improve risk adjusted returns, and you can take out regular income through the SWP, which is again advantageous for many investors from a tax point of view.
Thank you, Mr. Vetri. When we talk about investments in the stock market, everybody thinks about a mid cap, a small cap, the most volatile side of the equity market. Many a times, barring the seasoned financial planners, generally the attention doesn't go towards the hybrid. I fully concur with you that hybrid funds should be used by investors very efficiently. Reason is it will drive a balance between your fixed income and an equity. At the same time, you can sleep peacefully and leave the fund managers to do their job. And this will help you manage a risk-reward payoff. At the same time, manage your personal risk without you worrying about what happens in the market, what happens at the fixed income level, what happens at the equity level, what could be the valuation. I personally feel that the investors of today should make more and more use of hybrid funds. Thank you very much for bringing these thoughts, Mr. Vetri. Mr. Vetri, this video is likely to be published on Tuesday. By the time this video gets published, the results are out of the general election and we will clearly know which government is going to form. If the exit polls or if the opinion polls and other things to be believed, the current thinking is the same government is likely to continue, but the electorate is the final person who will say who will rule and who will sit in the opposition. The fund manager community which you represent, what are you expecting to happen in the next 5 years from the new government and how it will impact the performance of the stock market?
Sure. I think that's an excellent question. As you rightly said, none of us can actually claim to know the outcome of the election. Of course, everything that we've heard about the opinion polls, which came out more than a month ago, have given us some indication. But we can just look at scenarios. I think based on whatever we have seen of the past opinion polls, I have actually called this one of the most boring elections ever in the sense that the degree of suspense over the outcome was actually very, very low. I think what you should see is a continuity of policy of the last 10 years, presuming the government is re-elected, led by Prime Minister Modi. One of the underlying planks of this government has basically been the thrust on macro stability. And this macro stability has been achieved by making sure that your fiscal deficit, you try and stay disciplined. Even post-pandemic, we have been on a clear trajectory of bringing the fiscal deficit down, which many other countries in the world have not been doing. And I think it's a reflection of the discipline that the government has in terms of its approach to fiscal affairs. Secondly, the focus on managing inflation. I think this is not just an economic issue. This is also a political issue because data from India and across the world tells you that governments lose when they don't manage inflation. So I think flexible inflation targeting and the commitment of the MPC and the government is something which has been remarkable in terms of its display in recent years. Finally, I would say on these two issues, this is what underpins the macro stability. What we would look for in terms of continuation, Mr. Bhatt, is that the government in recent years has particularly talked about issues like ease of doing business. They have talked about the need to create more manufacturing jobs. They have implemented the PLI scheme. I think it will be more of the same, because we are now in a phase of implementation rather than any radical new reforms being required. I always say that today when I think about it, we don't really need any very dramatic, out of the box, radical reform, because those actually have a destabilizing effect. What we actually need now is implementation. And I think that is what the focus of the government is likely to be. Implementation in the area of manufacturing, PLI scheme, increasing FDI inflows into the country. All of these, I think, to my mind, will be some of the key items that the government will be driving in the next few years.
Our audience is primarily the NRI community. When we talk about NRI community, it's just not that they invest in India. They have a host of other investing opportunities like in US fixed income, US equities, real estate elsewhere, a lot of other places they invest. What is your message to the NRI community? So what proportion of their investable surplus, let's say that they have got 100 rupees, how much money they should put in India? And one of the serious doubts that they have is they know that they'll make money in the INR. In rupee terms, I'll make money. Will they really make money in dollar terms in the next 5 to 10 years? This is the doubt which is there in the minds of the NRI community. What answers you are having for these doubts and these questions that is there in their minds?
That's an excellent long list of questions, particularly which are relevant to the NRI audience that is on hopefully listening to this conversation we are having. First, let me start with the currency. I think one of the most important things to remember is that today India's inflation target, the way the governor describes it, is actually 4%. It's not even 4 plus or minus 2. And we know that in the US, the target is actually 2%. So I would say that we have moved away from an era where the rupee used to depreciate at 3.5%, 4.5% a year over a long period of time. In a given year, it may not depreciate. In a given year, it could lose 15%. But the average has been closer to 4%. I think we are now in an era where that gap is down to 2%. Why? Because our inflation target is 4, US inflation target is 2. So that gap in terms of depreciation as per the textbook theory is now only 2%. Secondly, what the textbook theory also tells you is that the depreciation can be lower than 2% if the country is able to improve its productivity. And many of the things that India is doing in terms of its policies are all geared towards enhancing productivity. So I think there is a reasonable case we can make that 2% depreciation is possible because of the inflation gap, but it could be even less than 2% a year if we are able to make progress on productivity. So that is one answer. The second answer, I would say, I don't think I'm qualified to tell anybody how much money they should have in India relative to other geographies, because each person's needs and where they may eventually want that money could be different. But let me put it the other way. If you were to look at some of the most attractive equity markets that you would want exposure to because these will help you meet your long-term financial goals, then it is unlikely that India will not figure among the top few markets, right? Because this is a country where there is growth. This is a country where we have high-quality entrepreneurs, and those high-quality entrepreneurs are able to use the growth environment to create valuable businesses, and that's what benefits investors in mutual funds which own equities. And the quality of companies, the quality of regulations that we have over here are very superior to that in many other emerging economies, which also may have the benefit of growth, but they don't have the benefit of quality of entrepreneurs and quality of regulations. So I would say that makes India a very attractive destination in any NRI's portfolio. The exact allocation may move around. It's a function of where are the valuations in India, where vis-a-vis maybe other valuation opportunities that NRI investors may be able to access. But certainly this should be part of your core portfolio. That is the way I would like to, leave my thoughts on the table.
NRIs have got one real fear, and that fear comes from what they have observed. What they have observed in the last 2.5 decades. There was the story of these BRICS countries, and there was a story of growing China. What happened in the China? In case of China, China was growing even till recently also, it is the fastest growing country in the world. But what happened in the stock markets of China? The Chinese stock market, the Shanghai Composite was at about 6,300 in 2007. In spite of literally 17 years of massive growth, you see the stock markets is half the level of what it peaked in the year 2007. The fear is India can going the same way? Is that the risk an international investor is carrying by putting their disproportionate amount of money into India? This is a genuine risk. The growth, yes. Whatever you say is yes. But will it result in a stock market growth for the investors?
As I said earlier, it is the nature of equity markets to shake. How do we tackle the fact that markets will be volatile? We tackle it not by trying to determine which are the factors that will cause it to be volatile or which are the factors that will not cause it to be volatile. We should be guided by only one compass, and that compass is valuations. The more expensive a market, the less you should be investing incrementally into that market, or you should be removing money from that market. When the market is very cheap, you should be adding allocations into that market. So my recommendation to investors would always be that structurally, please stay positive on India. But at the same time, you should never ignore valuations in your allocation. So you may have to figure out, okay, maybe at today's valuations, a hybrid fund which has less exposure to equity is more attractive than having 100% going into a new investment into a 100% equity fund. So please use asset allocation to manage that risk. And the second factor that I would say is that, if you are a global citizen and you have the ability to access in multiple markets, then you will find attractive opportunities in different parts of the world at different points of time. So by using geographic diversification and by using the dharma of allocation, which is linked to valuation, you will be able to ride the cycles far better. One final point. When we look at many countries where the stock market returns have been poor, one of the classic things that we find over there is that the quality of the entrepreneurs and the quality of corporate governance has been very poor or very weak. I think that is one of the good things that we see in India, that in general, now I cannot say this is true of every company, but in general, the threshold that companies have to meet in terms of corporate governance and quality is high. There is a respect for capital. How do we know there is a respect for capital? Because when we see companies, we find that their return on capital is quite good. It is well above the cost of capital. Investors look only at growth, but eventually return comes from companies where return on capital is higher than cost of capital. That is a situation where India is slightly unique compared to some of the emerging markets that we see. As long as this healthy respect for capital and return on capital is there, I would submit that in India's case, it is unlikely that you will see a great divergence between the growth and the return outcomes. Doesn't mean you don't practice valuation dharma, but certainly environment where capital is respected, the returns will, be commensurate.
Thank you, Mr. Vetri, for all these inputs. I'm very sure after listening to your eloquent arguments, the investors can take very informed decisions. The fears that could have been there in their minds must have receded to the lowest level now, and they must be inspired from what changes that are happening in India because of its economic growth, because of the regulatory action, because of the technology which has developed, and they loosen the purse and invest more and more into India. Thank you very much. We wish you all the best, and we remain in gratitude to you for your kindness to appear on our channel and bring this knowledge to the benefit of our audience. Thank you very much, sir.
Thank you so much. Delighted to have this conversation and look forward to having more NRIs supporting their country and investing actively in this country's growth.
Thank you. Dear viewers, hope you enjoyed the conversation I had with Mr. Vetri Subramaniam, and his conversations gave you insight about where you can invest and what exactly is happening in India and what to look forward going forward. If it did give you the required direction, please do not forget to give a thumbs up to me. Do share these videos with your friends and relatives, near and dear ones, and on all the WhatsApp groups on which you are connected with. Again, a sincere request, please do subscribe to this channel and press the bell icon. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another expert, with yet another topic next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.